The S&P 500 is a stock market index that includes 500 of the largest and most influential companies in the United States. Right now, it's hitting new record highs, which means the overall stock market is doing really well. Almost every sector or industry is seeing big gains. This includes technology, healthcare, finance, and other key industries. Exchange-traded funds, or ETFs, are a popular way to invest in a collection of stocks at once. ETFs like SCD, JEPI, and JEPIQ have been doing especially well. These ETFs have benefited from the strong performance of the S&P 500, especially after it reached key levels of support. Support levels are points in the market where prices tend to stop falling and start going up again. When the S&P 500 held strong at these support levels, it gave investors confidence that the market would continue to rise. Small-cap stocks are shares of smaller companies that tend to have a market value lower than larger, more established companies. These small companies have been showing great potential and are expected to perform better than the S&P 500 in the upcoming years. In fact, some experts believe that small-cap stocks could even double the growth of the S&P 500. One reason for this is that the new government policies are especially good for smaller companies. For example, deregulation, which means reducing rules that make it harder for companies to operate, and corporate tax cuts, reducing the amount of tax that businesses have to pay, help small companies save money. Small companies usually face higher taxes compared to large companies, so tax cuts can have a big positive effect on their bottom line. Another factor helping small companies is tariffs. Tariffs are taxes on imports, and they often make it more expensive for big companies that depend on selling goods from other countries. Small companies, on the other hand, focus more on selling to customers within the United States, so they don't face the same challenges from tariffs. Because of these factors, small-cap stocks are well positioned to do well in the future. Deregulation is when the government removes or reduces laws and rules that limit how businesses operate. This change allows businesses, especially banks, to have more freedom in how they lend money. For small-cap companies, this is a big deal because they often have a harder time accessing the funds they need to grow. Larger companies have more connections and can find ways around strict regulations, but small companies don't always have that luxury. When the government loosens these rules, it becomes easier for small businesses to borrow money from banks. This access to funding can help them hire more employees, invest in new projects, or expand their operations, giving them a better chance to succeed. Corporate tax cuts are another important change that benefits small-cap companies. Large companies, because they are much bigger and have more resources, often use advanced tax strategies to minimize their tax burden. These strategies may include complex financial structures and offshore accounts to reduce how much they pay in taxes. Small companies, however, don't have the same ability to use these strategies, so they tend to pay higher taxes relative to their size. When corporate taxes are cut, small-cap companies get to keep more of their earnings. This extra money can be used for things like research and development, expanding their product line, or improving their operations. The tax cuts level the playing field, giving smaller companies a better chance to compete with larger corporations. While the economic environment is generally positive for small-cap companies right now, there are still some risks that investors need to consider. One of the biggest risks is inflation. Inflation happens when the prices of goods and services increase over time. When inflation is high, the cost of things like raw materials, labor, and transportation rises, which can put pressure on businesses, especially small ones, to maintain their profit margins. To try to control inflation, central banks may decide to raise interest rates. Interest rates are the cost that businesses pay to borrow money, and when these rates go up, it becomes more expensive for businesses to take out loans. For small-cap companies, higher interest rates can be particularly challenging. Many small businesses rely on borrowing money to fund their growth, whether it's for expanding operations, buying equipment, or hiring new employees. When interest rates rise, it makes borrowing more expensive, which can slow down their growth or force them to scale back their plans. This can also affect their profitability, as they may need to use more of their earnings to pay off higher interest on their loans. However, not all small-cap companies will be equally affected by these risks. Some ETFs, or exchange-traded funds, are specifically designed to handle economic challenges like rising inflation and interest rates. These ETFs typically invest in sectors or companies that are better able to weather these economic shifts. For example, some sectors like utilities or healthcare are less sensitive to interest rate changes, as people still need those services regardless of economic conditions. Other ETFs may focus on companies that can pass on higher costs to customers without losing demand. These ETFs may help investors manage the risk of inflation and rising interest rates by offering a more stable return even when the economy faces challenges. Investing in small-cap ETFs is a popular way for investors to gain exposure to smaller companies while reducing some of the risks that come with investing in individual stocks. Small-cap ETFs pool together many small companies into one fund, making it easier for investors to diversify and spread out their risk. One particularly strong option is the Avantis US Small Cap Value ETF, or AVV. This ETF focuses on small companies that are undervalued but still profitable. Undervalued means that the market may be undervaluing these companies, and their stock prices are lower than they should be based on their financial health or potential. Investors often see undervalued stocks as opportunities, as the price might go up once the market realizes the company is worth more. By focusing on these undervalued companies, AVV aims to find small businesses that are positioned for strong growth, as their true value is recognized. One of the reasons AVV has been performing so well is that it has consistently outperformed both the S&P 500 and the Russell 2000, or IUV. The S&P 500 includes large established companies, and the Russell 2000 tracks a broad range of smaller companies. Even compared to these indexes, AVV has shown impressive results. The key to its success lies in its focus on both growth and risk management. Small-cap stocks in general can be more volatile, meaning their prices can rise and fall more dramatically than large-cap stocks. While this volatility offers the potential for high returns, it can also lead to significant losses if things don't go well. AVV manages this risk by carefully selecting companies that are not only undervalued but also profitable. This means that even when the market experiences downturns, AVV's strategy helps to minimize losses and cushion the impact. The ETF's focus on profitable, undervalued companies, combined with effective risk management strategies, provides a balanced approach to small-cap investing. Investors get the benefit of potentially strong growth in smaller companies while having some protection from extreme market fluctuations. This makes AVV an attractive option for those who want to participate in the small-cap growth story, but also value more stability and less exposure to major risks. The Avantis US Small Cap Value ETF, or AVV, is a well-thought-out investment vehicle that takes a unique and strategic approach to choosing stocks. The ETF focuses on investing in companies that show high profitability relative to their stock price, which is often a good indicator that the company is efficiently using its resources to generate earnings. These companies are typically strong in managing costs, generating revenue, and creating value for shareholders. AVV also targets low valuations, which means the ETF focuses on companies that the market may have undervalued, or whose stock prices are lower than they should be considering their actual worth. The strategy behind this approach is that these undervalued, profitable companies have the potential to grow significantly over time as the market eventually realizes their true value. By investing in companies that have strong financial health but are priced lower than their actual worth, AVV aims to capitalize on these opportunities for substantial growth once the market corrects its pricing. AVV employs a systematic, rule-based strategy to select stocks. This means the ETF follows a set of clear, predetermined rules for determining which companies to invest in, based on factors like profitability and valuation. The systematic approach adds a layer of consistency to the fund's decisions, helping to eliminate emotional or impulsive choices. At the same time, the fund is actively managed, meaning that the managers can make adjustments when necessary based on changing market conditions. This combination of a structured, rule-based approach with the flexibility of active management allows the ETF to be adaptive while following a disciplined investment process. One of the key strengths of AVV is its diversification. The ETF holds a large number of stocks, over 700 different small-cap companies, spread across various industries. By investing in so many companies, AVV helps minimize the risk that comes with investing in just a few stocks. This diversification lowers the impact of a single company's poor performance on the overall portfolio. Each individual stock in AVV is allocated no more than 1% of the fund's total value. This small allocation ensures that no single company can cause major losses in the fund while still allowing for the potential of high returns from many different companies. This strategy helps investors take advantage of the growth potential in small-cap stocks while managing the risks that come with their higher volatility. Historically, small-cap stocks have been valued at a premium compared to large-cap stocks in the S&P 500. This means that investors were willing to pay more for small companies' stocks relative to their earnings, often due to the potential for high growth as these companies scaled up and gained market share. Small-cap stocks tend to be more volatile, but they also offer more opportunities for rapid growth, which is why investors are often willing to pay a higher price for them. However, the current situation is quite different. Small-cap stocks are now trading at a significant discount compared to the past. This is reflected in their 50% lower PE ratio compared to large-cap stocks. The PE ratio, or price-to-earnings ratio, is a measure of how much investors are willing to pay for each dollar of a company's earnings. A lower PE ratio means that investors are paying less for small-cap stocks relative to their earnings, suggesting that these companies are undervalued. This creates an opportunity for investors who believe that small-cap stocks will eventually be recognized for their true value and experience price increases as the market catches up. If the right policies are put in place, such as deregulation, which removes unnecessary rules and restrictions that limit a company's ability to grow and innovate, and corporate tax cuts, which reduce taxes for businesses and help them keep more of their profits, small-cap stocks could soon trade at a premium again. Deregulation would allow small companies to operate more freely, giving them more room to expand and take advantage of new opportunities without the burden of excessive red tape. Tax cuts would also benefit small companies by lowering their tax bills, enabling them to reinvest more money into their business to drive growth. With these supportive policies, small-cap companies could see increased demand from investors, pushing their stock prices up and leading them to once again trade at a premium compared to larger companies. This would result in stronger performance for small-cap stocks, creating significant opportunities for investors who choose to invest in these undervalued companies now before they realize their full potential. Small-cap companies are particularly sensitive to interest rates because they often depend on borrowing to fund their growth. Unlike larger, more established companies, small businesses might not have the financial strength to fund major projects through their own earnings or other means. As a result, they frequently turn to debt, taking out loans or issuing bonds to raise money for things like expanding operations, upgrading technology, or hiring new employees. However, when interest rates are high, the cost of borrowing increases. This means that small companies have to pay more in interest on any loans they take out, which reduces their profit margins and can make it harder to grow. On the other hand, when interest rates are reduced, it becomes cheaper to borrow money. For small-cap companies, this is a significant advantage because it lowers the amount of interest they need to pay on their debts. With lower borrowing costs, these companies can use the extra money to invest in growth opportunities, such as expanding their product lines, improving infrastructure, or entering new markets. Lower interest rates also help improve their earnings because they're not spending as much on interest payments, which boosts their overall profitability. As a result, interest rate cuts provide small companies with more capital to fuel their expansion, making them more attractive to investors and positioning them for stronger growth in the future. Given the current economic conditions, small-cap stocks are in a prime position to perform very well in the near future. If inflation improves and interest rates are cut, small-cap companies will have an even greater opportunity to grow. Inflation reduction means that the costs of goods and services will stabilize, which can help small companies keep their expenses under control and avoid squeezing their profit margins. Meanwhile, if interest rates are lowered, small companies can borrow at cheaper rates, enabling them to reinvest in their businesses and drive growth. Right now, many small-cap stocks are undervalued, meaning they are trading for less than their actual worth, which creates an opportunity for investors. These companies may be flying under the radar, but as the economic environment becomes more favorable, their true value could be recognized, and their stock prices could increase significantly. The combination of undervaluation and strong growth potential makes small-cap stocks an appealing investment. To take advantage of this opportunity, investors can look to ETFs like AVV and other similar funds that focus on small-cap stocks. These ETFs are designed to offer diversification and risk management, two important factors when investing in small-cap stocks, which are often more volatile than large-cap stocks. Additionally, ETFs like AVV help minimize downside risk, the potential for losses, especially in a high-rate environment, While small companies are poised for growth, they can also face risks from changing market conditions. So ETFs that manage this risk effectively offer a balanced approach to investing in small-cap stocks. By investing in these types of ETFs, investors can gain exposure to the high growth potential of small-cap stocks while also safeguarding their investments against market fluctuations and economic uncertainties. With the right policies in place, such as deregulation, tax cuts, and interest rate cuts, small-cap stocks have the potential to perform very well, and ETFs like AVV are an ideal way to capture that opportunity without taking on excessive risk.